Do you know the difference between private equity and venture capital? A lot of people interchangeably use those words, and I can tell they don't know what they are. But if you want to invest in alternative assets, this is one of the fastest growing areas where people are building significant wealth. But private equity and venture capital are very different. So you need to understand the differences between private equity, which has its own variations within it, as well as the variations within venture capital. Again, two totally separate types of investment categories. So let's talk about what's private equity, what's venture capital, and how you should approach that as an investor. Now, I'm Matt Sorensen, Wealth Player. I've been advising clients for over 2 decades about how to build and grow their wealth, looking at clients making alternative assets, investing in private equity, investing in venture capital. I've advised private equity fund managers and venture capital fund managers. I've also invested in these deals myself using my IRA and personal funds. And that's right, your IRA or 401k can actually invest in private equity or venture capital. So let's start with private equity. Now, a lot of people are familiar with private equity from the big firms, KKR, Blackstone, Carlyle. These are some of the really big private equity firms that do billion-dollar transactions. And private equity itself has delivered some of the most significant returns amongst any investment class in the last 10 to 20 years. But what is it? Now, there's 2 primary variations of private equity. There's buyout and there's growth equity. Buyout is essentially what we think of as LBO, or leveraged buyouts, where a fund, a private equity fund, which consists of a group of investors and the fund manager, sometimes called the GP, will go and buy an existing business, try to improve it, and then sell it for a profit. That's basically what private equity is. They buy businesses, try to improve them, and then sell them for a profit. They're kind of like the guy buying a fixer-upper house that repairs it, fixes it up, and sells it for more money. That's what private equity is. They're buying existing businesses. But unlike venture capital, they're investing in existing businesses, proven profit, proven returns, proven team, proven products and services. Not some venture capital new deal or new company that no one's heard about, the product doesn't even work yet, and there's no customers. So private equity is very different. Private equity sometimes gets a bad rap because a lot of private equity firms will come in and lay people off. They try to find efficiencies. And some companies get a little bloated and sometimes need that. Maybe they go too far sometimes as well. Another knock that comes quite a bit at private equity is how they do leverage. That's where the buyouts are called leveraged buyouts. The private equity fund will use some of its own money, let's say 1/3 of the purchase price of the business, and then go get debt from other investors or private lenders to fund the balance. That purchase of the business is therein leveraged, and it might be 5-to-1, where 5 times leverage of debt is to 1 time of equity invested. Now, of course, the private equity firm only makes money if they can raise the value of the business and either take it public or sell it to another private equity fund or a strategic company in that industry for a profit. Now, venture capital, on the other hand, is where you're investing in startups. These are companies that haven't grown yet, that don't have a product yet entirely finished. They might have a concept or an idea. Maybe they do have a product, they're just not profitable yet. So these are much more riskier investments when we're in the venture space. Now, when you think about venture, one of the things you really need to know is it is much more risky. So you can't just make one bet into venture capital. You can't just invest in one startup with any expectation of returns. At our Alternative Asset Summit, we had Lisa Walker, Tech Coast Angels president, talk about investing in venture, and she said, if you're going to invest in one startup, the most likely outcome is you will lose everything. The most likely outcome in a startup in the venture capital space is that it's going to fail and you're going to lose money. But if you invest in one that goes really big, you can have significant returns because you're investing at a super early stage. So the typical rule of thumb is when you're investing in venture, at least make bets in 10 different startups or companies, hoping that one of them will go well, even if 9 of them wipe out and fail. Now, one of the best ways to invest in venture capital is into a venture capital fund, where the fund itself is then going to go make 10 different investments. I've actually invested in a venture fund myself just recently where I put a specific investment of money, but that fund already owns 8 existing companies. And they have intent to acquire more companies and take an interest in more. Now, in the venture capital space, typically the fund is only taking a minority interest in the business. The original founders, the people growing the business, are still involved and still have majority control. So in VC, you're betting on that founder growing that business and taking it to scale. In private equity, on the other hand, particularly in the buyout side of private equity, the existing leadership is typically getting sunsetted. They may stay on for a transitionary period, but there's typically new management that comes in private equity. So in the VC, you're betting more on the person guiding and building that business, where in private equity, you're betting on the business itself. Now, there's another variation of private equity called growth equity. Growth equity kind of sits in between venture capital and private equity. Growth equity is essentially a version of private equity where the fund is investing into the business, but the founders stay on. This is typically where a company is growing quickly, but has had returns and has an existing business, an existing team, and the management isn't ready to retire and go do something else. They want to stay on. It's not a startup, it's not VC, because it's an existing business that has sufficient revenue and profit. So it's in this growth equity stage, which is between, again, private equity and venture capital. Now remember, private equity, existing businesses, profitable. The goal there is to buy the business and sell it for profit. Venture capital, startup, much more risky, but you could have a significant home run return. You could be investing in the next Uber. What should you invest in? Well, I don't know. Maybe invest in both. There's great venture capital investments, there's great VC funds, there's great PE funds, and there's crappy funds in both categories as well. So what to invest in is the same thing like real estate or the stock market. It depends, of course. There's some great opportunities out there, some bad ones. But as an overall asset class, private equity has been delivering significant returns. Venture capital as well. We all hear the stories and see the Netflix specials and the movies about all these companies that go big and the investors that become millionaires. We're going to go in depth more in some later videos on private equity and venture capital itself and go into the details on how those funds are structured and the different varieties. But I want to give a brief overview about the difference between the two here. So make sure you're subscribed to the channel. We'll see you back next time.